following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and that theme song means we're back yet again with another live Volatility Views. We've been on hiatus for far too long, but now we're back for our regular monthly show here around expiration day here. And my name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And on the old program today, I'm not joined by my regular companion, Don Schlesinger, who's off in good old Paris dealing with some developments out there, but I am joined by a very able substitute. He's been on the show before. You know him, you love him. Of course, he is Bob Kraus, the CEO of the Volatility Exchange. Bob, welcome back to the show.
Hey, thank you, Mark, and welcome, everybody. I'm very happy to fill in for Don. I'm kind of champing at the bit to try and help out, but he's always hogging the limelight. So,
I told Don when we first started doing this, I said, Don, I'm going to make you a star. I think it's gone to his head now, Bob. I think he just loves it so much. He craves that microphone time, and he won't let anyone else have their time in the limelight. So you need to just shove him aside every now and then and say, Don, you need to share.
That's right.
But now we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome back to the Volatility Review. If you haven't joined us in a while, or if it's just been a while since our last live episode, this is, of course, where we break down typically the week's worth of activity from a volatility perspective. But since we've been off for about a month, it's a little bit longer time horizon this time around. And since we do have Bob here on the show with us today, and you guys at Volex are hard at work bringing those NASDAQ realized vol products out to make them available to our listeners out here, why don't we start then, Bob, with looking back at NASDAQ. It has been an interesting month from a NASDAQ vol perspective. Of course, a lot of interesting developments going on there. It's been earnings season. That's typically a very, very heavy driver of volatility from a NASDAQ perspective. Of course, we saw Google and Apple, two of the key drivers of NASDAQ volatility these days, reporting. So there's been a lot of developments there on that NASDAQ landscape and a lot of things to discuss since the last time we were on. So, Bob, why don't you pick up anywhere you want here over the past month's worth of volatility action in the NASDAQ?
Yeah, well, actually, let me move back into like the January, February area. Volatility in the NASDAQ and the S&P were very low. For NASDAQ, it was around, we got down to about 10% in realized volatility terms. And since then, through March, April, May, June, July, the volatility has been climbing until right around July 1st, where it kind of peaked around 23, 24, something like that for the NASDAQ. But since July 1st, then it's been dropping kind of in a steady state right to now, which, we're talking about 21% for NASDAQ and even lower for the S&P. Right now, the 1 month volatility in the S&P is around 13 and NASDAQ's around 15. So, that's on the low side of normal. How we like to do volatility cones and all of that. So we're typically on the low side of those things.
we'll save our prognostications for our later segment, our crystal ball segment, but it's something that we've been discussing on many of our other programs here on the Options Insider Radio Network for much of the past month, is just essentially that proverbial question of how low can the vol go, and how we've seen this interesting tendency amongst the liquidity providers and the market makers to, particularly going into the weekends, to see that, hey, everything seems to be settling down, apparently from a European perspective, even though that certainly isn't the case, really. But we're still seeing that tendency in the marketplace to want to unload a lot of premium, whether it's S&P vol or whether it's NASDAQ vol, whatever the case may be. And throughout the week, people are taking any chance they can get whenever there is even a remote uptick in the underlying. We're seeing these indices get crushed. We're seeing the vol products along with them get crushed. Even on days when there's a mild sell-off, we're seeing these indices getting crushed. So there is a lot of, apparently, maybe it's some of the leftover summer doldrums. Maybe it's a lot of people thinking we're essentially, there's more complacency in the air than perhaps there should be. Maybe it's a lot of people saying that we have this quote-unquote triple put out in the wings there of Bernanke and the ECB and all the other central banks out there ready to step in with essentially another QE program if the worst should come to pass. So people thinking that we're protected on the downside, or maybe it's a combination of all three. But whatever the case may be, there is certainly a willingness out there to unload premium, even at these levels, which are essentially, you're getting to the point where you're starting to say, why are you bothering? Why are you unloading VIX cash as we're talking today is up actually for a change. It's been a while, trading north of 14. It was south of 14. It was in the 13 handle earlier. So it's just been these vol levels are just getting to the point where I know Don's not exactly a ardent proponent of buying premium, Bob, but I think you're more middle of the road when it comes to that. But I think it's definitely at least from your perspective, when you're looking at the vol cones, I think even Don couldn't argue this. You definitely probably would want to be more leaning towards the not sell than the sell part of that equation.
Well, right. That Don is definitely a short premium a seller, but that doesn't mean that he's indiscriminate premium seller. So, right now, I think it'd be very risky to be short. The weekly options, for instance, we have about 4 or 5 days of trading left to go, and the at the monies are around $7. So on the S&P, and so you could essentially for 14 points, put on a straddle there, and if the market moves 14 points in either direction, you're golden. And you can easily remember days even in the past month where the market moved 14 points. I mean, that's not hard to do with the S&P. That's a 1% move. And so, over 5 days, boy, I can't see selling options with those kinds of low premium levels.
And there certainly is, we talk about people wanting to and having, I suppose you can say, a lack of hesitancy to sell these premium levels. But there also are a few people filing into the, let's say, the more aggressive, opportunistic camp, if you will. We've seen this in the past, even when people are comparing, let's say, a purchase of a typical S&P downside put versus, let's say, some sort of volatility product from a hedging perspective. The put usually wins, except in those scenarios where something like the VIX, let's say, just pops and dramatically outperforms in that black swan moment. In those scenarios, something like an upside call or an upside call spread in VIX are certainly are dramatically outperform the typical downside buy you might want to make in, let's say, an S&P put. And we're seeing some people starting to follow into that line of thought. I'm looking here at some of the numbers for today while we're recording, and already today looks like maybe looks like quite a few of the SEP 45s, 1,000 traded today in VIX calls. We see 5,000 of the SEP 50s, 5,000 again of the SEP 55s. Looks like a spread went up there. But we're seeing a lot of, perhaps not a lot, but certainly a relative pattern to people starting to prep for some upside. Looking today, the NOV 32 HAPS went up 7,000 times. So people are starting to perhaps regardless of what they're doing on the downside, or perhaps if they are premium sellers in, let's say, S&P vol, they're starting to put on those upside VIX, I suppose you can call them kickers, to prepare for these, 1 in a million scenarios where the VIX does pop. Because it seems like we're kind of stuck between two relative scenarios now, where we see the VIX kind of languishing at these levels, and then, or NASDAQ vol, same thing, languishing at these levels and perhaps continuing to drift ever so slightly downward, or the other hand, where it just pops dramatically off of some news out of Europe, or perhaps some dramatic announcement out of a big tech name driving the NASDAQ, or whatever the case may be. So we see people seem to be positioning for both of these two scenarios, the lackadaisical sell-off where they're still willing to sell premium in the NASDAQ and in the S&P, and also prepping for that 1 in a million upside in case the worst does go against them. Well,
that's absolutely true. But, even in the lackadaisical case, could the market move 1% in, the next week? I mean, even if it were just, hanging around, it could easily move 1% over the course of a week. And, when I say 1%, that's buying both sides. So it's really, selling or buying this option is an at the money is 0.5% right now. The market, even when nothing happens, could easily move 0.5%. So it'd be extremely risky to be selling these options at these levels right now.
I agree, and I've been saying that for it seems like quite a while now, and yet people seem to be routinely ignoring me and just taking any opportunity they can to hit some bids, and let's say it's S&P at the money vol, or NASDAQ vol, or whatever the case may be. People are not reluctant at all to put that premium away and sell it and come buy it again on a rainy day, perhaps. And that's going to do it for our volatility review segment. And now Bob and I are going to dive right into a very interesting and exciting volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that funky tune means it's time once again for the Volatility Viewpoint. This is where Bob and I welcome some luminary from the world of options and trading. We get to pick their brains for a half an hour or so here on the program. And today's willing guest / victim is Mike Dever. He is the founder and CEO of Brandywine Asset Management. He is also the author of the recent book, Jackass Investing, Don't Do It, Profit From It. I like that title, Mike. So, Mike, welcome to the show, sir.
Thank you, Mark.
I'm glad we can have you on. And what we like to do with some of our newcoming guests to the network and to this program is to give you a little chance to kind of run down your recent history in the financial realm, particularly for our audience as it pertains to options and derivatives.
Certainly. Yeah, I started trading over 30 years ago, and I started right in futures and options. I didn't start, as most people do, on the equity side and transfer over. And traded as a CTA for most of the past 30 years now, most recently having relaunched a product that we had traded throughout the 1990s, a program that's broadly diversified across multiple over 100 markets. We launched that last year, pretty much in line with the publication of my book as well. So I've got a long history in derivatives markets and trading using primarily systematic trading methodologies.
And Mike, what does CTA mean for those that aren't too initiated with the term?
Right. So commodity trading advisor, which is a bit of a misnomer because we don't just trade commodities, but it's a dated term that goes back to the 1970s when the Commodity Futures Trading Commission was given authority over futures trading.
I've always had a problem with that term CTA. It's kind of like managed futures. It's such a broad thing to lump together in one kind of term like that, and CTA
right.
is the exact same thing. It's very broad.
yeah, like hedge fund.
Exactly.
What's that mean? Yeah.
Exactly. Well, Mike, before we dive into some of the book and some of the other discussion topics, are there any specific asset classes that you like to specialize in? Are you perhaps a corn versus wheat guy, or what commodities really drive your interest? Are you more on the financial realm?
You know what? We're really broadly diversified. We look at 6 sectors, which are 3 financial, which is stock index, currency, and interest rates. And on the commodity side, we have the agricultural commodities like corn and wheat, and the metals and the energy complex. So we try to keep balance across the portfolio. Our philosophy is that we can earn the best returns over time by diversifying across various return drivers and markets in the portfolio.
And Mike, do you ever use options or like take delivery, anything other than just strictly futures trading?
Well, we have historically, not so much taking delivery, but we have used options historically. In this program today, we're not. We look at options and we look at, volatility. We have some of our strategies based on that, but we're using futures for the execution.
Okay, great.
All right, and Mike, since obviously this is a volatility-focused program, we'll dive into the meat of the subject there. And I think let's start with, I think, a very, very basic concept, which is the volatility itself. Now, a lot of people out there, particularly asset managers, they look at volatility and they see it essentially as being synonymous with risk. Volatility is risk to them. And yet, I know, giving a cursory look at your book here, you take a somewhat different approach. How do you typically categorize risk when you're looking at it, when you're talking about it with your clients?
Yeah, we really look at risk not so much as volatility, and I'll explain why that is, but ultimately over time, drawdown, how much you actually lose, is the real definition of risk, because that's what you have to recover from. And the reason I say volatility is not a good measure of risk, and this is for an investor looking at different products to invest into, is because it often is hidden. There's so many strategies, you guys are well aware, that could have low volatility in their performance over long periods of time, but have that black swan event, that something's out there that just goes out multiples of whatever their regular volatility had been and wipes out accounts. And so when I talk about risk in a portfolio, what we talk about is really understanding the underlying return drivers that are driving every single investment that's in the portfolio, understanding the source of the returns. And if you know that the source of the return is from a mean reversion strategy and some sort of a credit spread, and it may look like low volatility, but you realize now that you've got this credit quality or some sort of blowout in credit spreads that could destroy that. The second thing is, volatility on an individual position basis is also somewhat irrelevant to me. We look across the whole portfolio. So there may be some strategies that you see the performance of that are very high volatility, and doesn't mean they're risky. And certainly in a portfolio context, they could add a lot of diversification value that lowers the risk of the entire portfolio. So we really think volatility is a very difficult way or inaccurate way to look and try to determine whether there's risk in either an individual position or across a portfolio. You really need to understand the return drivers.
So you're not one of these CTAs out there who's just quoting the Sharpe ratio all day. You actually dive more into the meat of what actually goes into calculating that and across the different spectrum of assets that you're actually trading and the unique risks to each of those.
Yeah, we really do, and we encourage our investors or prospects to dig into that as well. We're not a black box. We sit down and we'll actually expose specific strategies in our portfolio that we use. We don't show everything, but we've got dozens in the portfolio. So for us to essentially hand out a few of those as an example of where the return drivers are coming from and how we allocate across those in the portfolio gives them a comfort level, that we are diversifying properly, we are reducing risk, and it doesn't, at the same time, it doesn't, give away the whole show on our end.
Now, let me ask you this. This is one of my favorite, I suppose you can call it a pet peeve type of question of mine lately. I've been at a number of different general investing events and talking to a lot of different asset managers and advisors out there. And it still amazes me that in 2012, there still is a prevailing mindset out there that you could achieve true diversification in this day and age with so much symmetry and correlation across asset classes just with, let's say, typical basic defensive stock selection. And I've always maintained that you really can't achieve that true level of diversification without at least some derivatives component in your portfolio. Given your background, I'm assuming you're going to agree, but I'll let you say it for yourself if you think it's possible these days in 2012 with so much broad correlation across asset classes to be able to really diversify without incorporating, let's say, a put or some other volatility-based component to your portfolio.
Right. No, I certainly agree wholeheartedly with your statement there. And that was the basis for my book, for Jackass Investing. And the title, what it really refers to, and if you've seen, they've had these Jackass movies that have been out there, and these guys that are just jumping off of buildings and doing a lot of stupid stuff. Now, they're getting paid for it. They make a movie. But Jackass Investing is taking unnecessary risks and not getting compensated for it. And most people, when they create a portfolio, are doing exactly what you described. They're diversifying across various long positions in highly correlated, or certainly when there's an event, highly correlated positions. And they look at it, and maybe even in a normal time, and I'll put that in quotes, they may have some low correlation among those positions in the portfolio, but certainly there are events that drive the same results, and usually negative, across that portfolio. So you absolutely cannot achieve proper, true diversification by simply diversifying across equities, or, as I define in the book, even asset classes, which tend to have, they're just a simplistic, and I kind of view it as a archaic, construct that people created in the 60s to aggregate different positions because they didn't have the computer power to really break it out by return drivers. But diversifying across asset classes does not provide true portfolio diversification.
Yes, that old school mentality of you have, let's say, 60% in stocks, 20, 30% maybe in bonds. And if you're really crazy, maybe a few percent here in some commodities like gold or what have you. And then you were truly diversified and protected against everything that could possibly come your way. And that seems to be a very antiquated mindset in this day and age. But, I wanted to hit on something you just mentioned, because you talk about this, you're right, in your book. One of the themes of your book is that you can increase returns and also reduce risk at the same time. And to me, reading that little subtitle bullet point there really says to me that you're preaching the wisdom of using derivatives in your portfolio. Is that something you really get into in the Jackass Investing book? Are you telling the readers to really come in and they should be hedging their portfolio using options or something along those lines?
I do. Now, I don't go into so much the specifics in the instruments, whether it should be an option or a futures contract, for example, or other derivative. What I talk about is looking at the underlying return drivers. And the very first chapter of the book, and the book's arranged as a series. It's 20 common investment myths. And I go through and I say, okay, the first myth, that stocks provide an intrinsic return, for example. And then I lay out why people may believe that to be true, and then why it's really not true. And in the case of that first chapter, I go through and I reveal through research the two primary return drivers that drive stock prices. It's not just the magic risk premium that's given to investors for buying stocks. It's a combination of earnings growth and the multiple people are willing to pay for that. And that explains 90% of stock price action. But it's not so much that I say, okay, you need to put this option strategy onto that, although in the action section for the book, I do give some specific trading strategies and investments people can make to diversify that include, those types of positions. But it's mostly trying to get people to focus on the different return drivers. And the final chapter, which you were alluding to there is no free lunch, is the myth that you can't enjoy both greater returns and less risk. And I actually put a portfolio together that does use derivative strategies in it to show how you absolutely can do that. You can earn greater returns with less risk if you create a truly diversified portfolio.
Hey, Mike, I'd like to come back to one thing you said, and you're talking about how volatility of returns may not be the best measure of risk, and you're talking about drawdown. But when you get to a drawdown, isn't that sort of like getting the negative volatility, so to speak, or the negative return in a row? One thing that struck me very interestingly, just recently, about I'd say 3 or 4 weeks ago, there was a very interesting radio broadcast called Stochasticity, I hope I said that right, on NPR, and they were talking about doing tests to try to predict or find randomness, and one of the things that people didn't do as much is sort of create strings. In other words, if you were trying to come up with a random series, just out of your imagination, you would often not put in as many strings as real randomness occurs. And so my point is, with drawdown, aren't you just getting sort of this unlucky string of randomness in a row that makes, the peak to trough drawdown maybe not necessarily a good measure of the risk that the portfolio is taking?
And I don't know if that's possible. And I don't know that I'm saying, and maybe I misspoke by saying the best indicator of risk is drawdown. It's really the best, feeling of risk is drawdown. Volatility to me is moderately irrelevant, especially on an individual strategy basis, individual positions. But drawdowns are something that are real, and you have to recover from those. But you are right in the sense that they aren't themselves maybe the best measure of risk, especially because if you're looking at a low volatility position over the past decade, it's also probably had low drawdowns, in it. So it doesn't stand out as being any more or less risky by looking at drawdowns than volatility. Yeah. The bottom line is you have to understand the return driver. You have to understand that the return driver for that position, even though it appears to be consistent, has certain events, what I describe as angry environments, that are unsuited for it, that could either destroy it entirely or totally change the character of the return stream. But I think you probably are right. I mean, drawdown is not necessarily a replacement as a measure of risk for volatility. You still need to look at the return drivers and understand those.
Oh, great. And just for the audience sake, I met Mike probably, it was about 25 years ago, I think.
Yeah, it's been a while.
Yes, so we go way back. And one of the first things I remember you saying, which really, sat with me and I've thought about many, many times, is this idea that many investors think that, or they've been told, you can't time the market, so don't even try. That's like a fool's game, et cetera, et cetera. And then, like 2 seconds later, they say, well, yeah, but, now's a really good time to go buy Microsoft kind of thing, and so, I hear this, that you can't time the market. And then they start talking about essentially timing the market. Now, maybe it's more of a longer term time the market, but, what do you feel about this? And I know that that's in your book, and I remember you saying it 25 years ago. So maybe you could enlighten our audience with the thought process.
Sure. Well, what I say in the book is that everybody is a market timer. Nobody isn't taking a selection of where they want to put their money that's sort of random. They're making a decision to put it in there, and at some point they take it out. And they're the people that are saying they're not market timers mean that they kind of just don't have a plan for when they're putting it in and taking it out. And the people that they referred to as market timers are those people who move in and out more quickly without a plan. And so the reality is you've got people that are out there, and you've got studies that are great, like the Dalbar studies that are saying, hey, on average, the people that invest in mutual funds, equity mutual funds, underperform those by 5% a year, the very funds they invest into. And that's just saying that they get in when those funds are high and they get out when those funds sell off. And my point is that if everybody's a market timer, you're not just given a position when you were born and don't have to make any decisions. You're making investment decisions all the time, making a decision to avoid looking at a market, not looking at agricultural commodities, for example. Well, that's a timing decision as well. You've just made the decision that you want to be flat in that market. So don't pretend you're not a market timer. So if you are, go about it in a systematic, rational way to try to capture excess returns from it. And I actually give a specific strategy in the action section for the book that takes advantage of the fact that most people can't market time correctly, that they do it erratically or irrationally or emotionally. And that strategy is looking at money flows in and out of ETFs, primarily this U.S. stock ETFs, leveraged and inverse. And if you see a lot of flows going into leveraged inverse ETFs, for example, in the U.S. stock market, you know that there's a very bearish sentiment that's building up. And the strategy just has certain points where those levels reach a point where we say, okay, now's the time to buy that market. And vice versa on the sell side. It's fairly selective. It's not in that often, but it'll hold a position for a month or so, and it'll outperform the market on a buy and hold basis by double-digit percentages a year. I mean, it's amazing how effective it really is.
Well, Mike, you have a lot of interesting concepts that you discuss in your book here, but one of them I want to ask you about specifically because it has that great ring to it is, of course, that beautiful losers concept. So what are you talking about there when you're discussing this hypothetical beautiful loser?
Right. So I give an example in the book of two trading strategies that lose money. Over time, they had a net negative return. And it's interesting when you look at it in the book and you can see why they were. And one of them, it's U.S. stock market, had over a decade period with a negative return, and it's because it has such big negative drawdown periods. And then I offset that with something that's totally negatively correlated with it. And what the combination turns out to do is reduce that drawdown period in each of those negative strategies so that they're much, much smaller. So when they do have a year where they have decent return, they're not just simply recovering from a fraction of that drawdown, but they're actually entering into new high ground and new performance. So it's actually two strategies that each individually have negative returns, but in combination, because of the diversification value they provide each other, the portfolio has a positive return. It just really shows the power of true portfolio diversification.
One of the things you also hit on in your book, which is, I think, a bit of a sad chapter and a sad indicator of the way our business is going, is, of course, the whole post-Madoff regulatory environment that we find ourselves in, and how, unfortunately, at least from an options and derivatives point of view, compliance is the growth area of our business these days. We're seeing groups across the board who are compliance-centered really just growing like mad because there is such a demand and also a congressional oversight demand for more regulators in this space. So I know you touch on this a little bit in your book, but kind of what is your I suppose you can call it your pain to the masses there. What do you say to your readers out there about who are concerned about the current state of regulation and oversight in our business here?
Yeah, so I have a myth in the book that's government regulations protect investors, and it's just not true. Investors have to watch out for themselves. I mean, government regulations, at best they're backward-looking and they're reactionary. They don't anticipate what may occur and position for that. So for example, you'll have, people that got scammed in the 70s in commodity scams, and then you have regulations that say, well, you really can't invest in these commodity funds, because unless you're a super wealthy investor. Well, the very people who can benefit from those most are the small investors who are gambling with their money by having high concentrations in long U.S. equity positions. But they can't do it. They're not even allowed to go into those positions. You certainly can't look at something like Madoff or something that's happened now with MF Global or PFG on the future side and say that government regulations can protect investors, because they were heavily regulated. PFG had the regulators in their office when the fraud was uncovered by the owner of the company. Madoff, the same thing. So you really need to ask the right questions yourself, and I put up some of the list of the questions like that in the action section for the book. But the investors have to take it into their own hands, their own research, and they can't rely on the fact that somebody's registered, that means anything. That doesn't protect them.
Yeah, unfortunately, your side of the fence, the future side of the fence, has really just had a 1, 2, 3 punches, 1, 2, 3 knockout of late over the past year. We saw, of course, MF Global, which was just a catastrophe. And more recently, we saw, of course, our friends over at PFG and the implosion of that firm due to fraud, and Refco back in the day, a little bit back. So it's been a series, a succession of just bad news out of the future side of the space. I'd imagine a lot of your potential clients are coming to you concerned about that now. I don't have the same protections in the futures realm that I have in, let's say, a typical savings account. And so, how does that apply? Do I have the SIPC protection and all the other things that go along with it? And I'm sure there's a lot of people just asking you these questions these days because, particularly from a futures perspective, that is top of mind right now.
Yeah, we do get those questions, but I think, unfortunately, people aren't as informed as they should be, so we get less of those questions than I would expect or almost welcome. The reality is, though, if somebody has a sizable investment portfolio, there are no sure things. There's no place where they can put it and have it fully guaranteed. The bank has limitations on the guarantees. SIPC protection is limitations on the guarantees. And the reality is when you put money into a futures account with a futures broker, generally, like in our case right now, maybe 7% of that money is being used for margin. So 93% of your assets are somewhere else that we're trading on your behalf. They're not sitting there at the futures broker. So even if you have a failure of a futures broker and you don't recover all of the assets, which nobody thought was possible over a year ago, and now they're starting to realize that's a possibility until things get changed in the regulatory environment, and the legal environment, you still have got much less at risk than if you had money, millions of dollars, sitting with a securities broker. So it is risky, but everything is. And it's just a matter of being smart about who you're investing with and understanding where your money is.
Well, Mike, I think that's about all we have for you today. But before we go, are there any other, let's say, upcoming amendments to your book or any appearances you want to mention or any perhaps future books you're working on or anything else you want to tease here for our listeners before you go?
Sure. Well, the book, we do have, the book is in print, and it's about 300 pages in print. And then we have about another 100 pages that are on the website. It's the action section for the book, which is regularly being updated, which is why it's not in print. And that action section at the end of next month, so by the end of September, will be totally upgraded. If people want to take a look at it and log in now, they'll get updates when we complete that. But it allows people to go in and create their own portfolio, track the performance of that portfolio on a daily basis. And we actually have specific trading strategies, we reveal in that action section that we'll be updating on a daily basis, giving actual buy-sell signals in the action section. So it's something if people are interested in following, one way of trading a diversified portfolio, we do disclose everything in that, so that it gives them a good example.
And why don't you tell them the URL they can check out if they want to see that for themselves?
Sure, that's www.jackassinvesting.com.
And Mike, one last thing before you go is with your CTA, your trading program, is it if somebody wants to invest with you or trade in that program, is it kind of that's the program and, take it or leave it in a manner of speaking? Or do you, can they customize it more to suit their needs, more like an investment advisor would?
Right. So they can customize it to some extent. I mean, for example, we're talking with an investor right now that's not interested in any trend following type strategies. They've got that in their portfolio. So we have the vast majority, 79% of our risk exposure in our portfolio is from non-trend strategies. So we can pull out the trend following strategies, still have a majority, of the portfolio still intact, and they can get that in a customized way for them. We prefer to trade the most broadly diversified model we possibly can, which is our Brandywine Symphony program, and you can see that over at brandywine.com. But if people do come with a different need, we can modify that to suit their needs as well.
That's great.
Well, Mike, thank you very much for joining us today, and we'll definitely have to bring you back on again down the road. We can look back in some more detail at some of your trading strategies as well as what you have going on with the amendments and the addendums to the book. Sounds like it might be an interesting ebook coming down the road where you can have all these updates and additions pushed out to the listeners on an all more automatic basis, and they can even just buy the ebook and follow along with you as you continue to evolve the book.
Absolutely. That's something we've discussed, and I appreciate it, Mark. Thanks for having me on, and you as well, Bob. Thank you.
All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and those haunting tones mean it's time for the crystal ball segment. I always joke that it's a sad, sad tune, Bob, because it also means we're coming to the end of our show. But before we do close out the show, we of course have to dive into what we're watching and what we're seeing in our collective trading screens, our crystal balls, as you will, for the future from a volatility perspective. And Bob, we were talking about the top of the show here, and looking at NASDAQ first, it's really just amazing how the levels we're trading at right now, and we were hinting at what we think the future may hold, but I have a feeling that you're not going to wholeheartedly recommend that our audience line up and start blasting out straddles in NASDAQ vol.
Certainly not selling them. I mean, we're hitting lows in the VIX that haven't occurred since 2007. So, it's been a long, long time before we've seen VIX levels at 14. And, sometimes these weekly options are under that because of the way the VIX is calculated using all the options, and sometimes the out of the money puts, even when at the money options are cheap, the out of the money puts kind of bump those up. So, when a VIX value of say 14 comes along, typically the at the money options are, in the 10s, 11s, that kind of thing. So at 10% volatility, that's much less than average and extremely risky to be selling these options. Not that it can't go to 9 or at 8, but it's kind of like a rubber band, and you can only push it so far and then it comes snapping back. So like we were mentioning before in the review section, the premiums are just so cheap right now that I think you either have to buy them or, stay away. But, at 0.5% or 7 points on the S&P for the next 5 days, or similar premiums for a longer term, it seems like you got to be on the buy side.
I don't know. I could just see Don listening to this tomorrow and somewhere in Paris, wherever he is, and just his head exploding because we recommended buying vol and buying premium here on the show. So I'm sure you'll be getting a very hastily written email from Don as soon as he hears this episode, Bob. So I look forward to seeing that.
Yeah, I now have to be careful when he comes back from Paris. So.
And unfortunately, that's going to do it for this episode of Volatility Views. But before we go, Bob, we haven't had you on the show in a while. And so I know a lot of our listeners, and I certainly am as well, we're all curious about how things are progressing there over at Volex and how you're looking on the NASDAQ contract front. I think the last time we talked, we were looking at sometime in Q3 into Q4 for a launch date for some of those NASDAQ realized vol products. Is that still the tentative time frame going forward?
Yeah, I think that it's going to actually be first quarter next year now. The one issue we had is we don't want to just throw something, up on the wall, so to speak, and see if it sticks. We want everybody to be there on day one. And so trying to, herd everybody and have them all ready for day one is kind of like, catching a whole bag full of cats kind of thing. So it's been kind of difficult. We're still working very hard on doing it, but we want to do it the right way. We want to launch with everybody on the same page before we do it. So I'd rather not hastily just get it out because we said, we could. But to actually do it the best way we think possible. And so that's going to take a little bit more time. We still have a couple more agreements to put together, but rest assured, we're still on the ball. We're still, working diligently to do that. And, I apologize for for the extra time that it's taking, but hopefully we'll get it done right and, be something that's very useful, very liquid, kind of right out of the box.
For our listeners who are not familiar with the new product development cycle here in the options and derivatives business, I think to call it glacial is being charitable. So this time frame that it's taking for you guys to actually get these products from concept into a potentially tradable and viable product is actually relatively speedy compared to a lot of the other products I've seen in the past. It's not uncommon for me to hear about a product and someone come knocking on my door and say, Mark, you have to see this new product X that we're going to launch and we're building it right now. It's going to launch in Q3 or in a couple of months from now, and then I'll hear from them again in a year and they'll say, oh, it's still coming, and then a year down the road and 3 to 4 years down the road they're still working on it and there's still some regulatory hurdle to overcome. So the fact that you guys are moving at a much faster pace, I think, is encouraging, even if it means our listeners have to wait a little bit longer before they can get their hands on those realized vol products from NASDAQ. I know given the environment right now, I'm sure we'd have a lot of listeners who'd love to come in and pick up some realized vol contracts for their own portfolio. That would be certainly a fruitful time for you guys to have them in the marketplace. But I know they'll be ready and willing when the products finally do launch.
Yeah, absolutely, Mark. We're getting, comments and questions all the time, and there seems to be lots of interest, and we certainly want to, satisfy the demand. It's just, like I said, getting all the ducks in a row from day one is a bit of a challenge. So we're going to do it, and, bear with us, but, we'll do it right. Hopefully, and we'll have the maximum liquidity there, right out of the box.
All right, listeners, well, you heard it here first, listeners. The NASDAQ vol contracts are on the horizon. You might have to wait a little bit longer for them to be tradable in your account, but they'll be there sooner than you think. And, of course, we'll be back sooner than you think here on Volatility Views. We'll be back in September with some new live shows that your listeners can look forward to, a lot of interesting new guests, and a lot of more fun stuff in store for you, the listener. But unfortunately, this is indeed the end of this program, but we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.